A very good day to all of you, and we are on to the last part of chapter number 2, Basic Concepts of Macroeconomics, and we are going to study 3 more new concepts. One is the net indirect taxes. Under this, we'll be speaking about indirect taxes and subsidies. We'll be talking about the difference between factor cost and market price, and finally, we'll be concluding with the topic net factor income from abroad. All these new concepts which we are learning, they are laying the basis for your macroeconomics national income accounting lesson, especially the numerical part of the lesson. However, it is advisable that before we go further into the details of this lesson, we do take a quick recap of what we have learned in the lesson about domestic territory, normal residence, what is the difference between factor income and transfer income, difference between final goods and intermediate goods, consumption goods, classification of consumption goods into 4 categories, and capital goods, and gross investment, net investment, and depreciation we just covered in the previous lecture on this lesson. Today, so let's get started with the topic, that is net indirect taxes. Net indirect taxes, for calculation of net indirect taxes, you need 2 components. One is the indirect tax and the second component is subsidies. So let's understand what is indirect tax and what are subsidies. However, before we take up this topic, let's talk about some of the indirect taxes which we are paying. So if I go to buy a bar of soap in the market, I'm paying something little extra than what the value of soap was when it was within the production boundary. So this extra which I am paying, I call it the GST. So GST as of now is the best example of the goods indirect tax which you can remember. You also pay an indirect tax when you are importing something into the country in the form of customs duty. Then there's a VAT on petroleum products. When you're using power, there also you are paying a tax. These are all examples of indirect taxes. So let's understand what are indirect taxes. So the key words to know what are indirect taxes is, we have learned that indirect taxes are taxes which are imposed on the production of goods. Now, who has the right to impose taxes on the production of the good? It is the government who has the right to impose taxes on the production of goods. And when these goods are sold in the market, the indirect tax is added to it, and then you buy the good from the market. Can you avoid paying the indirect tax? Yes, you can avoid paying the indirect tax. If you don't buy the product, you don't pay the indirect tax. But we have to understand that when we are buying any product, whether it is a magnifying glass you are buying, or anything, eatables you are buying, or you are buying a calculator, anything you are buying from the market or from the producer, you are paying a tax on the product which you are consuming. So we have to understand that indirect taxes lead to increase in prices of goods. The other component is subsidies. So subsidies are not like taxes. Subsidies, the other name for subsidies is economic assistance or financial assistance. The idea of providing subsidy is, it is giving you some kind of assistance in order to meet the social welfare objectives of the government. So this subsidy also is provided by the government. You presently are getting subsidy on the LPG cylinder. Farmers for many years have got subsidy on the fertilizers because the government wanted the farmers to use fertilizers in order to produce more output for the country. So the idea of providing subsidies is, or this financial assistance is, to promote or encourage the consumption of certain products. The government is also giving subsidies on setting up industries in the backward area. So it's kind of financial help or economic assistance which is provided by the government, and we consider it as a transfer payment because government is providing this subsidy with the objective of fulfilling certain social welfare objective. It does not contribute to any value addition, and it does not contribute to the current flow of goods and services. So that is why subsidies will be considered as transfer payment. The government can also provide subsidy if the government wants to encourage export of certain products. So when we compare indirect taxes and subsidies, indirect taxes increasing the price of the good. On the contrary, subsidies are leading to a reduction in the price of the good in the market. So these two concepts are very, very important because we are going to use it frequently when we are going to solve numericals of national income accounting. So basically the concepts need to be understood and the formula needs to be learned. That is, net indirect tax is the difference between indirect tax minus subsidies. Here a few MCQ questions can be asked, and these are situation based questions and you have to give your answers after understanding the formula. We can take up two situation based questions. The first one is if subsidy is equal to 0, this part becomes subsidy is equal to 0. In that case, the net indirect tax will be equal to indirect tax. Case 2 is if I assume that indirect tax is 0, in that case net indirect tax will be negative. So such case studies or such cases can only be understood when you learn this formula, and then accordingly as the question has been asked, accordingly you can answer the question. Also remember that the concept of net indirect tax will not arise in a two-sector economy where we only have households and firms interacting with each other and there are no leakages, and this concept is only relevant in case of a three-sector economy or a four-sector economy where you have the government sector and the rest of the world respectively. Now, why are we studying the concept of net indirect taxes? Because we want to understand the difference between market price and factor cost, and going further ahead and linking this to the production boundary which we have done previously, we said as long as the good is within the production boundary where you have intermediate good 1, intermediate good 2, intermediate good 3, the good is at factor cost. The moment the good crosses the production boundary and is in the market, something additional added, and that is in the form of net indirect taxes, and the good becomes at market price. And just now a minute ago we said that you want to avoid net indirect taxes, you can very well avoid it by not purchasing the good, so you won't be paying the net indirect taxes. Now this flow chart, it helps us whenever we are doing these concepts. It's always advisable to do these flow charts and learn the concepts with the help of the flow chart. So talking about the movement from market price to factor cost. So when you subtract net indirect taxes from market price, the product will become at factor cost, that is within the production boundary. And if the product is moving outside the production boundary, the net indirect taxes, which we've just learned, is indirect taxes minus subsidies. So if you add the net indirect taxes to the factor cost, the product will become at market price. This concept has to be very well understood, and also the formula for net indirect taxes, that is indirect tax minus subsidies. So let's understand the difference between market price and factor cost if it has to be understood in the form of a definition. We understand by factor cost, that is the amount which we pay to all factors of production which for their contribution in the production process. So within the factory, the product is at factor cost, then the amount which we have paid to the 4 factors of production, that is land, labor, capital, entrepreneur, in the form of rent, wages, salaries, interest, profit, all this is the amount which is paid to the factors of production within the production boundary, and the product is at factor cost. The other concept is market price, that is when the net indirect taxes are added to the factor cost, the product becomes at market price and it has crossed the production boundary. And if we have to define and understand it in terms of definition, it is the price at which the product is actually sold in the market. This is what is meant by market price, and definitely the difference between factor cost and market price, as we know, is of net indirect taxes. The last unit of this chapter is regarding the net factor income from abroad, and it is the difference between factor income from abroad minus factor income to abroad. What is factor income to abroad? Factor income to abroad is the amount which is paid to the normal residents of other countries. So something is flowing out of your country to the non-residents for their factor services but within the economic territory. So then what is factor income from abroad? It is coming into the country. So it is the factor income which is earned by normal residents of the country from the rest of the world in the form of interest, in the form of wages, in the form of dividend, in the form of retained earnings. And if we find the difference between FIFA minus FITA, that's how we popularly remember it and easy to remember also. That is, FIFA minus FITA will give us the net factor income from abroad. Repeating the key terms of the definition, the components of FIFA and FITA. FIFA, the main components is income earned by whom? The normal residents. FIFA, it is from, so from the rest of the world in the form of wages, interest, profit, dividend and retained earnings. So something is coming to you. FITA is that something which is going out from your country. So it is factor income paid. The difference, please note, this is earned. Factor income from abroad is earned. Factor income to abroad is paid. Normal resident is common. From to other countries. Okay, this is from the rest of the world. This is paid to the other countries for the similar factor services which are provided within the economic territory. And the difference between FIFA and FITA will give you the net factor income from abroad. The reason why we are studying the net factor income from abroad, which is the difference between FIFA minus FITA, is because it will help us to understand the concept of domestic income and national income in a much better way, because these concepts, these parameters are important in distinguishing between domestic income and national income. So here's the flow chart. So just as we did for factor cost and market price, we find it easier to use a flow chart to understand the difference. How is national income different from domestic income? So if from the national income we remove the net factor income from abroad, and which we've studied that net factor from income from abroad is nothing but FIFA minus FITA, what we get is domestic income. And if to the domestic income we add the net factor income from abroad, what we get is national income. National income is also known as net national product at factor cost, and domestic income is also known as the net domestic product at factor cost. Sometimes if you are asked to find national income, you can add domestic income and net factor income from abroad, and you will get the national income, which is nothing but net national product at factor cost. So here also you have to remember three things: that net factor income from abroad can be positive, net factor income from abroad can be negative, and net factor income from abroad can also be 0. So in that case, just remember the formula FIFA minus FITA. Okay, if your FIFA is more than FITA, the net factor income from abroad will be positive. If FITA is more than FIFA, then net factor income from abroad will be negative. And when will net factor income be equal to 0? When FIFA is equal to FITA. In that case, net factor income from abroad will be equal to 0. So these are basically case 1, case 2 and case 3, which you must know for conceptual understanding, and for doing your MCQs, this is very important. The last topic of our lesson is we are going to now learn about what are the components of the net factor income from abroad. If we can see in this flow chart, we see that there are three components to the net factor income from abroad. The first component is net compensation of employees. The second component is net income from property and entrepreneurship. And the third component is net retained earnings. Now, do I need to learn this? Yes, you need to learn this for a theory question, because for a theory, a 3-mark question can be asked in the board exams, and you need to know the 3 components of the net factor income from abroad. Now, how do we arrive at these components, that is the term net, in all the 3 cases? In all the 3 cases, just remember it is from -2, from -2, from -2. Now, what from -2? We'll be studying about how to arrive at net compensation of employees, how to arrive at net income from property and entrepreneurship, and how to arrive at the net retained earnings. If we add all the 3 components, we get the net factor income from abroad. So now we will understand as to how to arrive at net compensation of employees. And so to understand this definition, we must remember that how to arrive at net compensation of employees, the things which we have to keep in mind is that it is the difference of the income from work received by resident workers who are living or employed abroad for less than 1 year. Okay, and removing, that is minus, the similar payment made to non-residents staying or employed within the domestic territory for less than 1 year. So something what you are receiving in the form of compensation of employees, and something what you are given to the non-residents in the form of compensation of employees will give us the net compensation of employees. The second component of net factor income from abroad is the net income from property and entrepreneurship. Here also it is the difference between from -2, and the main components are income from property and entrepreneurship, which we are receiving in the form of rent, interest, dividend received by residents, and the similar payments which we are making to the non-residents will give us net income from property and entrepreneurship. The third component is net retained earnings, that is the undistributed profits of a company, which the company reserves either for paying the corporation tax or it reserves it for paying the dividends. So how do you find out the net retained earnings? It is the difference between retained earnings of the resident companies located abroad and the retained earnings of non-resident companies located within the domestic territory. That will give us the net retained earnings. So again, remember, it's the difference between from -2 that will give us net retained earnings. So the net factor income from abroad has 3 components. What are the 3 components of net factor income from abroad? They are net compensation of employees. The second component is net income from property and entrepreneurship. And the third component is net retained earnings. And you must remember that net factor income is 0 in a closed economy, because in this economy we are not interacting with rest of the world. With this we complete chapter 2, and happy learning, children, because we are now going to move to chapter number 3, where our concepts which we have learned in the last 2 lessons will be really handy in solving the numericals easily.